The devil wears Prada, even in tough times. Today, we're going to talk about luxury brands, real estate, and how it's all connected.
Trillions of dollars of commercial property loans are coming due in the next few years. It's causing some pretty big concerns in the financial sector.
Sounds pretty alarming, doesn't it? But it seems like it isn't that alarming at all for luxury brands, because they continue to buy billions of dollars of commercial properties, even though everyone keeps saying that commercial real estate is done. Are they crazy or just plain genius? To understand their strategy, let's first dive into the heart of the real estate crisis and understand their motives behind their investment.
I mean, what if I don't want to live the way you live?
Oh, don't be ridiculous, Andrea. Everybody wants this.
This is Fifth Avenue. It is one of the most expensive streets in the world, filled with expensive retail stores. It is also one of the most famous streets in New York. If you haven't visited in person, you've definitely seen it in movies, commercials, and the news. Brands like Armani, Bulgari, Cartier, Dolce & Gabbana, Gucci, Tiffany. This 6-mile street is filled with fancy stores. But all those luxury brands aren't what makes Fifth Avenue expensive. It's the real estate prices. Just imagine, Fifth Avenue office space landlords ask for up to $2,000 per square foot there. Meanwhile, the average rent for office space in New York City is around $80 per square foot and $90 for Class A buildings. The reason for those sky-high prices is pretty straightforward: an intense competition for revenue between luxury brands. It all started with Tiffany. More than 100 years ago, the fancy jewelry store made this place remarkable for visitors. So other retailers also kept an eye on Fifth Avenue. Year by year, the more luxury boutiques opened their doors, the more famous the street became. And this raised competition among brands, resulting in a true real estate hunt. It was just a matter of time until luxury retailers started buying properties there instead of renting them. For example, Prada bought a 12-floor building for $425 million, but they decided this wasn't enough. So they also got a neighboring building for another $800 million. Prada is not the only one on the list. Gucci parent company Kering is ready to pay $1 billion for a 115,000 square foot retail space a few blocks south on Fifth Avenue. Meanwhile, giant LVMH, who owns brands like Christian Dior and Louis Vuitton, is also in the game. They're going to buy another Fifth Avenue retail space. These fashion houses are buying all these spaces for several reasons. One, purchasing real estate is much more reliable and profitable than renting it. Two, there is a high demand for luxury goods among Americans. Last year, retail sales in this sector reached $75 billion just in the US alone. This is almost 8% more than a year before. Next, offline commerce in this segment is much more popular because people are looking for the experience. Besides, many products are simply not available online. And on top of this, every brand tries to impress its customers. So they add extra lounges and services. That's why they need more space. And they prefer to buy the real estate because renting all of that will be too expensive. But wait a minute. If hundreds of brands are spending billions of dollars on properties, why is everyone saying that commercial real estate is in trouble then?
City office buildings are in trouble.
What I call a CRE tsunami that is coming.
It's going to be okay in multifamily, but the office market is going to be destroyed.
There are almost 19,000 office buildings in the US. Most of them are in New York, California, and Florida. And it's no surprise that the same states are the go-to choice for luxury brands. But all of those spaces, nearly 1 billion square feet, are vacant. Just imagine, it's like having 40,000 vacant floors in an average office building tower. Why is that? This year alone, the debt for residential and commercial properties will reach over $900 billion. It is almost $8 trillion, and that's just in the US alone. What does it mean for commercial real estate then? Well, borrowers have to refinance their loans at a much higher interest rates, or they might need to sell their properties at a big discount. But here's a weird thing. On one hand, the value of commercial real estate transactions in the US dropped by over 50% in 2023. But for some reason, finding bargains to buy is still hard, even though it is counterintuitive. In this situation, every economist expected commercial real estate to fall for a couple of years now. But why aren't most owners selling their commercial properties? This is the question everyone is asking. Will this market ever fall? There are a couple of indicators that also caused this crisis in the first place. The main one is not surprising: rising interest rates. The impact of increasing borrowing costs can be huge. It can discourage spending, hiring, and investing. It can also decrease the value of risky assets like stocks. How? By increasing yields from bonds and savings accounts. This financial tightening can affect industries relying on debt, like commercial real estate. As a result, this can slow down the economy, leading to a recession. Why is this happening? Responding to high inflation, the Fed raised interest rates, and as a result, they went from 0 in nearly 2022 to over 5% by the following summer. What happened next? The increase in borrowing costs and remote work reduced office space demand. That's how commercial properties got in trouble in the first place. And as the demand became lower, the value of those properties also dropped. Some lenders, like Silicon Valley Bank, were not ready for this. Thus, their portfolios of bonds and mortgages experienced a huge decrease in value. We've talked about this issue with Silicon Valley Bank in this video. If you haven't watched it, feel free to check it out after finishing with this one, because this crisis might not be over yet. Since then, lenders are feeling the pain of losses. They worry about late payments and loan defaults, and as a result, banks became more cautious when it came to lending for commercial property. Higher interest rates also resulted in higher payments on existing debt and caused a domino effect. Now, commercial real estate landlords face challenges. Banks face challenges. And of course, small businesses also face challenges. On a positive note, inflation decreased from its peak of 9% in the summer of 2022 to below 4% in recent months. So the Fed will consider implementing several interest rate cuts this year. Still, some worry that interest rates might not drop fast enough to prevent the crisis. So many are concerned about refinancing and handling debt obligations. Thus, over $2 trillion in commercial mortgages are set to mature by the end of 2027. And if lenders won't be able to pay this amount, we will see a crisis. But a good thing is that there's still time left for the Fed to lower both inflation and interest rates.
Over the next 2 years, in the U.S. alone, $1.4 trillion of debt coming due. Much of that won't be a problem, but there's a lot of it that's office debt.
But wait a minute. Why would I care if I don't own any commercial properties? Well, the main issue is that this situation affects the U.S. economy and therefore every American. How? To answer this, let's go back to 2019. Here is sunny San Francisco, with over 75% of the city's land area used for offices. In comparison, this number is 49% in downtown Manhattan. What happened to San Francisco office market after 2019? It transformed. A lot. It shifted from being the strongest in the country before the pandemic to the weakest. And now it has the highest office vacancy rate in the US.
San Francisco has always been a boom and bust town.
By the end of 2023, San Francisco office vacancy rate reached 28%. It's the highest number ever recorded. This is even bigger than the peak vacancy rate during the Great Recession in 2008, which was almost 18%.
There's really been a perfect storm which has kind of imploded downtown San Francisco.
Currently, over 30 million square feet are available for rent in San Francisco, which is over a third of the total inventory. Well, that doesn't sound good for those landlords, but still, most people just started to work remotely and their companies are still up and running. How can this influence every American? 2 words: domino effect. Let's remember that apart from offices, there are many offline businesses depending on them. Like what? We got restaurants, cafes, shops, and even co-working places. They're usually located near big office centers, so people could rest there while working. This is also known as foot traffic. People go to work and then home, and they can visit these cafes several times daily. Of course, they spend money there too. and getting a cup of coffee or lunch is a typical thing. That's why those places make their living off of office workers. Still, one day, everything changed. People started cooking and dining at home and drinking their coffee in their kitchens. While some enjoy the comfort of remote work, others suffer colossal losses. Many people in retail lost their jobs, and this business still needs time to recover. For example, San Francisco downtown traffic is 67% from pre-pandemic times today. Many stores and coffee shops simply closed. A similar situation happened in many other American cities as well. In the end, what local business can survive with no people around? Today's closure rate for American companies is around 20%. That means a large number of businesses could not survive. So they're closing and leaving office spaces and the areas nearby. But commercial real estate is diverse, and not all commercial properties experience the same difficulties. For example, the retail sector is not feeling the pressure as office spaces. The national office vacancy rate is at a record high, reaching 19%. Meanwhile, the retail vacancy rate, it's really low, just above 4%. And we're already seeing proof of that with all the luxury brands buying real estate. But why in the world would they do it in an era of online shopping? Well, unlike many mass market retailers, fancy stores are tied to commercial real estate. Why? Besides their merchandise, they also provide a unique customer experience and service. This is part of their value proposition and is essential to their clients. Because when buying an expensive bag, most people are not just paying for that bag, they're also paying for the experience. But do luxury brands have any investment strategy, or they're just simply buying anything that they can get in a busy market? Well, I will say that they do have a clear vision of what they're looking for in the properties they invest in. From what I see, the decision is based on location, popularity, and the income of the people in that location. For example, Washington, Florida, New York, and California are states with the highest number of luxury stores. And not surprisingly, the residents in these states have the highest personal income across the US. What a coincidence, isn't it? On top of this, there are many foreign tourists there as well. And that's an extra opportunity to tap into the influx of money, unlike e-commerce. Another factor luxury stores always have in mind is the rental growth, since the rent is not always fixed. Some commercial rentals charge a percentage of the sales generated by the brands. Rental growth usually indicates strong demand for commercial real estate, which makes it an attractive investment opportunity for luxury brands. This way, they can enjoy asset value appreciation and long-term profitability. Sounds like luxury brands know what they're doing when investing in properties. But what should we expect next in the commercial real estate market? On average, the rate of U.S. office space usage stabilized at around half of what it was before the pandemic. It is still lower than in Europe, where it's typically 70 to 90%, and in Asia Pacific, where it's usually 80 to 110%. But let's face it, hybrid and remote work are here to stay. So office owners and investors will have to adjust. These days, people talk about rebalancing the sector. That's why many consider converting office spaces into residential spaces, especially if the multifamily sector remains stable. What's your opinion on the future of the U.S. commercial real estate market? Can luxury brands improve the situation? Let me know down in the comments, and I will see you in the next video. Take care. Bye-bye.